Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the top 10 best companies to buy right now. So essentially, we're going to identify companies that are trading under their actual value, their fair value, and their true value, making them some of the best stocks to buy right now on the stock market. We'll be analyzing these various companies with the help of this Morningstar article because not only are these phenomenal companies in my opinion, but these are also the best companies to own according to Morningstar, which is a very prestigious financial institution. If you've watched the last video, you know we are in a series right now about the best stocks to buy on the stock market right now. So we'll be going over the best growth stocks to buy, the best value stocks to buy, which is this video, the best cheap penny stocks to buy, and just the best stocks to buy overall, which was last video. So for more videos just like this one on the best stocks to buy right now, and if you want videos on the best stocks that I'm personally buying, remember to go and annihilate that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's just dive right into it. So the first company we're going to talk about is GSK. Now, if you look here, you can see we have 5 bullet points, and all of these are very important regarding the overall company's value. Essentially, we're going to start off talking about their price/fair value. And basically, we would want this to be as low as possible because the lower this metric is, the better buying opportunity they are, according to Morningstar. We're also going to talk about their uncertainty rating. So we want to identify companies that are medium to moderate, which are relatively safe. We want to make sure that their moat or their overall market that they're appealing to is stable and wide. And we also want to make sure that they have a standard capital allocation or better. On top of that, our last metric is going to be the industry in which they are located in, because right now, even if a recession happens, we want to buy companies that won't negatively be affected too much by a recession. And that's why we're starting off with GSK, which is one of the largest pharmaceutical companies in the entire world that is most notably known for their vaccines. This company has a very expansive list of a plethora of various patented pharmaceuticals that earn the company a very wide and stable economic moat, which is very positive. This means that even if a recession occurs, we can rely on this very innovative value stock to hold our portfolio through that overall recession, because we know people aren't going to stop buying pharmaceuticals because essentially their lives could depend on it. According to Morningstar, the market is underestimating this firm's overall growth potential, and I agree with them, considering that GSK trades for a 31% discount from their fair value price, which should be around $50 as of right now. Essentially, the company's true value, according to Morningstar and myself, is around $50, but the current share price is trading at 31% below this overall metric, making GSK one of the best stocks to buy on the stock market right now. The next company we're going to talk about is a technology company that is in the software industry, referring to their overall applications, and it's none other than Tyler Technologies. As you can see, Tyler Technologies has a better price/fair value rating than GSK, coming in at just 0.68. And as we go on further into this list, you can see that each company is going to be better than the last. At least better in the sense of their price to fair value rating is actually lower, meaning it's a better buying opportunity for these amazing value plays. Tyler Technologies, similar to GSK, has a medium uncertainty rating, a stable moat, and a standard capital allocation rating. However, Tyler Technologies is one of the clear leaders in their respected industry, and they are very undervalued in their niche market. Particularly, Tyler Technologies is fantastic because they offer the government operational software. Morningstar, as well as myself, believe this company has a very good long-term trajectory, even though in the short term, the company could experience a few pullbacks. For instance, the decade-long runway for this growth company is absolutely phenomenal, considering that they are known for their prestigious technology, which they give to the government. However, in the short term, Tyler Technologies management actually expects some revenue contraction, meaning that the revenue could temporarily shrink in terms of their overall growth rate over the next year. But over the long term, the company is more than positioned to bounce back, which is why Tyler Technology stock, according to Morningstar, is trading at a 32% discount below their fair value price target of $475, making this one of the best undervalued companies to buy right now, making it a phenomenal value stock to purchase and add to your portfolio. Or at minimum, feel free to look into any of these companies. But when I give a buy rating, that means I personally will buy and nibble at this overall company. But you always need to make sure to do your own research. Up next, we have Anheuser-Busch, which has a price to fair value ratio of 0.67, a medium uncertainty rating, a stable moat. However, they have an exemplary capital allocation rating, making this company absolutely phenomenal. So we'll get into what that means in just a moment. This is a brewing company, so essentially they sell alcoholic beverages and different types of drinks. And they have a vast global presence in very dense populated areas. And Anheuser also has one of the strongest cost advantages in their entire industry, which would be beverages, more specifically brewers. This company is a phenomenal defensive company in some regards, and it's among some of the most efficient operators in their respected industry. As of right now, this company is very underappreciated and undervalued, considering that they're trading at a 33% discount from their fair value estimate, which should be $90. Again, this is a phenomenal company to buy, especially if you're trying to identify very undervalued companies in this current stock market, which are also very stable companies to buy even during a recession. Up next, we have a company that you may not even know about, named International Flavors and Fragrances. They have the same price to fair value ratio as Anheuser-Busch, and they have a medium uncertainty rating, a stable moat, and their capital allocation rating is standard. However, what makes this better and higher on our list than the other companies we've talked about? This is literally the largest specialty ingredients producer in the entire world, and they have recently struggled to fight against higher inflation, which has taken the world by storm. This has clearly been weighing on their overall profit growth. However, the company is cutting overall costs and have cut their overall guidance for the year of 2023. Despite this, many professionals believe this company is going to bounce back very aggressively in regards to their profits during the year of 2024 as inflation starts to ease. On top of that, their management has a fantastic growth trajectory, and Morningstar believes this company is likely to succeed over the long term, and I agree with them. That's why, according to myself and Morningstar, right now is an excellent buying opportunity for long-term investors when it comes to this overall company. They have a very wide moat, and the company is trading 33% below their fair value of $140. So what are you waiting for? Make sure to go and do your own research on this company to see if it's a great addition to your personal portfolio. Up next, we have TransUnion, and their price to fair value is 0.66 with a medium uncertainty rating, a moat that's stable, and a capital allocation rating that is exemplary. This company is over in the consulting services industry, and they are a leader in this respected space. TransUnion is a leading consumer credit bureau, but they are facing headwinds from lower mortgage activity. But despite these headwinds, regarding people aren't necessarily too enthusiastic about buying houses right now, overall, they are very well positioned to have robust financial metrics throughout the year of 2023 and beyond, regardless of this minor headwind. Now, even in a recessionary environment, TransUnion is set to produce very impressive organic growth in their overall revenues. This is another reason why TransUnion is a phenomenal company to buy even if you are anticipating a recession. Currently, the company trades at a 34% discount below their fair value estimate of $99 according to Morningstar. Up next, we're going to talk about a company just like them, which is Equifax or Equifax, depending on your pronunciation, which is another leading credit bureau. This company has a 0.64 price to fair value ratio, a medium uncertainty rating, a stable moat, and of course an exemplary capital allocation rating. This company clearly is also in the consulting services industry, and they are one of the best in my opinion, despite the headwinds that we talked about when we talked about TransUnion regarding mortgages. But even despite that weakness, the company is still set to generate very impressive overall revenues. Many think that Equifax Workforce Solutions segment is differentiated enough and will enable them to bring in large profits due to this diversification. The fundamentals of this company are extremely strong, which is one of the things I love and what I look at when evaluating an overall company. And according to professionals over at Morningstar, they believe this company is undervalued by 36% because they should be trading 36% higher than their current share price. So overall, this is a very strong company to look into. However, the list gets better and better because we have none other than Walt Disney. This company has the exact same price to fair value ratio of 0.64. However, they have a high uncertainty rating, which is actually not that good. Their moat is stable and they have exemplary leadership, especially as they brought back their former CEO. And if you know anything about Walt Disney, you know that they are in the entertainment industry. Walt Disney recently actually reported very good earnings results and revenues, and since they brought back their former CEO, they have continuously made phenomenal decisions in management regarding cutting costs, cutting jobs, reducing the overall non-sport content spending, and they are also restructuring into 3 segments. Those segments are going to be entertainment, ESPN, and experiences, which would include parks, content, and other types of products and services relating to those. They also have showed a very impressive Disney Plus, Hulu, and ESPN growth rate, which is going to be one of their long-term growth revenue drivers. As of right now, according to Morningstar, their current fair value estimate should be around $155. However, the current share price is trading at 36% that actual price, meaning that this company is undervalued by 36%, making it a phenomenal buying opportunity literally right now. Next up, we have one of my favorite companies that I personally own in my stock portfolio, and that is Roche. And this company essentially is a pharmaceutical manufacturer. They have a price to fair value ratio of 0.63, making it the best on this list so far. They have a low uncertainty rating, making this a phenomenally stable company. Even during a recession or a stock market crash, they have a stable moat, exemplary overall capital allocation, and this company is undervalued by 37% according to professionals. They should be trading at around $57 per share, but the market right now is too scared to treat this company how they should be treated. The company's overall portfolio regarding pharmaceuticals is very expansive, and they have industry-leading diagnostics products which provide significant competitive advantages which differentiates themselves from their competition. This is a Swiss healthcare company, so not only do you get diversification and stability, but you also get international exposure. And this Swiss healthcare giant is in a very unique position in their overall space regarding their very innovative pipeline of pharmaceuticals that they have in their portfolio. So I expect Roche to continue to achieve high growth, and I think they are in a very good position in regards to their overall competition. Now up next, we have another company that I absolutely love, which is Taiwan Semiconductor Manufacturing. They have a price to fair value ratio of 0.62, a medium uncertainty rating, a stable moat, and exemplary capital allocation. This company focuses clearly on semiconductors because it's literally in their name. The stock is literally the world's largest dedicated contract chip manufacturer and maker, which was recently in the news last month due to Berkshire Hathaway, which is Warren Buffett's holding company, slashing their stake in this semiconductor giant. The reason why this is controversial is because Warren Buffett's Berkshire Hathaway recently added more of this company back in 2022, but then last month they literally cut their overall position. However, I think that was a huge mistake by Berkshire Hathaway, considering that Taiwan Semiconductor is very undervalued by around 38% below their fair value rating according to Morningstar. So they should be trading at around $140 per share, even though right now the company's trading for around $90. In general, I am very confident in this overall company over the long term. The only problem would be geopolitical factors because this is a foreign company. Taiwan is a region that does experience a lot of political turmoil, and if anything were to happen over there, that would be problematic for shareholders. But my confidence in this company long term is not necessarily going to be shaken, considering that this is a very high performing stock. Another phenomenal holding opportunity right now, and it's actually the last stock on our list, coming in at a price to fair value ratio of just 0.62, is Comcast. The uncertainty rating for this company is medium, the moat is stable, and the capital allocation rating is standard. Now, you may be wondering to yourself, there are other companies on this list that have better uncertainty ratings, moat ratings, and capital allocation ratings. However, according to their price to fair value ratio, and remember, we're talking about value companies in this video, this is the best bang for your buck. Comcast has a phenomenal cable business, even though their overall growth has slowed. Nevertheless, Comcast is enjoying their competitive advantage regarding their solid pricing power. They have a very strong balance sheet, in my opinion, and Comcast is aggressively repurchasing shares. So what does that mean? It means that the company's management is buying back their shares because they believe the company is either undervalued right now, which I agree it is undervalued right now, and they believe that the future share price is going to be substantially higher than their current share price. Right now, the current share price is around $36, but their fair value estimate for this company should be close to around $60, making this company a phenomenal buying opportunity, meaning this company is trading between a 38 and a 40% discount from what they should be trading at. So overall, these are some of the best value stocks to buy right now on the stock market. Even if a recession occurs, these companies are going to be solid investments, considering that they are already phenomenal buying opportunities from a value standpoint. So I would love to hear your thoughts down below about any of these companies. Subscribe if you are new, smash that like button for more videos just like this one, and especially if you are enjoying this series right now, and I will see you in the next YT video.